Hello and welcome to your channel name. Today, we are diving into one of the most significant laws in the Indian banking sector, the Banking Regulation Act of 1949. If you've ever wondered how banks in India are regulated or what ensures your money is safe, stay tuned. Let's begin with a little history. The Banking Regulation Act was introduced in 1949, soon after India gained independence. At that time, the country's banking sector was unorganized, and there were many challenges like fraudulent activities, mismanagement, and no proper control over banking institutions. This act was passed to bring structure, stability, and security to banking. Now, what exactly does this act do? The Banking Regulation Act provides a legal framework that governs how banks operate, how they lend money, how they are supervised, and much more. It empowers the Reserve Bank of India, the RBI, to regulate, inspect, and oversee banks in the country. But it's not just about nationalized banks. This act applies to all banking companies, whether they are public or private sector banks, and even extends to cooperative banks. First, we have Section 5, which provides definitions for important terms like banking, banking company, and other crucial words. For instance, banking is defined as accepting deposits of money from the public for lending or investment purposes. Seems simple, right? But these definitions lay the foundation for the entire regulatory framework. Next is Section 6. It talks about the various forms of business in which banks can engage. This includes borrowing, lending, issuing letters of credit, and dealing in foreign exchange. However, it also sets limits. Banks can't just do any business. They have to stick to the activities related to banking. Now, let's talk money. Section 11 deals with the minimum capital requirements for banks. Every bank, whether Indian or foreign, must maintain a certain level of paid-up capital and reserves. This ensures that banks have enough financial cushion to handle risks and unforeseen circumstances. Without this safeguard, banks could easily collapse under financial pressure. One of the most important parts of the Act is Section 21. This section gives the RBI the power to control the advances or loans that banks provide. The RBI can issue directions on how much interest banks can charge, the type of collateral they should accept, and even the maximum amount a single borrower can take. These regulations help prevent bad loans, which is a major issue for the banking sector. Let's move on to Section 24, which introduces the concept of the Statutory Liquidity Ratio, or SLR. It requires banks to maintain a percentage of their total assets in the form of cash, gold, or government securities. Why? Because it ensures that banks always have liquid assets to meet withdrawal demands, thus preventing a cash crunch or panic among depositors. Now, who keeps an eye on the banks to ensure they are following these rules? That's where Section 35 comes in. It gives the RBI the authority to inspect banks and scrutinize their operations. RBI officers can check everything, from a bank's financial health to its adherence to laws. If anything is found to be wrong, the RBI has the power to step in and take corrective measures. And if things really go south, Section 45 comes into play. This section allows the RBI to remove or replace a bank's board of directors if they believe the bank's management is not acting in the best interest of the public or the banking institution itself. The Banking Regulation Act has evolved over time. In 2020, a major amendment was passed to bring cooperative banks under tighter regulation, allowing the RBI more control over their operations. This was in response to some high-profile cases where cooperative banks faced financial troubles. So, what's the impact of this act? It has been a cornerstone in maintaining public confidence in the banking system. By giving the RBI the authority to regulate and supervise banks, the Act ensures that banks are managed well, customers' deposits are safe, and the overall financial system is stable. In conclusion, the Banking Regulation Act of 1949 is much more than a set of rules. It is the foundation that keeps the Indian banking sector secure and functioning smoothly. Whether you're a bank customer, a banker, or just someone curious about how the system works, it's important to understand this act and the role it plays in safeguarding our money. I hope you found this video informative. If you did, don't forget to like, share, and subscribe for more such content. Thanks for watching, and I'll see you in the next one.